Demand for silver is basically off the charts. The silver price in China, it's still well above here. India's industrial demand is increasing very, very rapidly. I think what we saw was something which was an opportunity by the swaps, by market makers, by bullion banks, basically to hit the expiry of the February contract at a time when China had packed up and gone home for the weekend.
Rising counterparty risks in silver and gold contracts, with examples of major players facing significant losses on shorts. To what extent do these risks systematic vulnerabilities in COMEX and London markets?
The authorities are actually quite good at hiding these things. If someone gets into trouble, they will be bailed out and we won't know about it.
How do we know how much China bought?
Just look at the premium in Shanghai compared with prices in the West. Gold is interesting because there isn't very much difference between the price on the Shanghai Gold Exchange, the spot price in London. As JP Morgan are now forecasting a price at the end of this year of over $6,000.
You've highlighted the intensifying squeeze in silver markets, including physical shortages and derivative pressures. What key indicators currently suggest this could lead to a broader repricing of precious metals?
Well, we had a bit of a shock.
We did.
Literally a few days before we're recording here, and we're still recovering from it. I think the thing to look at is the silver price in China. It's still well above here. Demand for silver is basically off the charts, and you've got two things now working for higher prices. The first is industrial demand. Bear in mind that India's industrial demand is increasing very, very rapidly. The second thing is that you have in Asia, if you like, a greater affinity with silver as metallic money than we do in the West. In the West, we see it as small change, silver coins, which are always fairly insignificant in terms of their value. But in Asia, it's a completely different story. China was on silver standard until 1935.
The real story here isn't silver hype. It's geographic demand shifting the pricing power eastward. As Alasdair Macleod explains, China's higher silver price compared to Western markets signals physical demand outrunning paper pricing systems. India's industrial silver consumption has surged alongside solar manufacturing growth, with global photovoltaic demand rising over 20% year over year in 2025. That combination of monetary culture and industrial usage creates a demand floor Western traders may be underestimating. Investors should watch Asian premiums more closely than COMEX headlines. And as Alasdair Macleod implies, the next shift may come from physical markets forcing paper markets to adjust.
And in the Middle East, when I first went to the Middle East, which was in the 1970s, Maria Theresa dollars were still circulating and being used as money, certainly in the Bedouin tribes and also, a bit more widely. So, they know that silver is money. We slightly dismiss it, and consequently, you've still got queues around the block for silver bars, silver coin, whatever, throughout Asia. Now, we're talking about a very large proportion of the global population, if you like, going for it. So, silver, if you look at the price in China, in Shanghai, I closed last night something like 111, while here we were around about 80 or a bit less than 80. So you can see that there's a significant premium there. Our paper price hasn't caught up with the physical price, and I think that's the key thing to understand. So I think it's being drained out of Western markets.
The premium gap between Shanghai and Western silver prices quietly exposes where real demand lives. Alasdair Macleod points out that silver trading near 111 in Shanghai versus roughly 80 in Western markets represents a massive arbitrage signal, nearly a 35% regional pricing difference. Historically, sustained commodity premiums across exchanges rarely persist without physical inventory flows correcting them. When physical metal moves east, Western inventories tighten even if futures markets look calm. This divergence matters more than daily price volatility for long-term investors watching metals supply chains. As Alasdair Macleod suggests, the arbitrage pipeline may reveal stress before markets publicly acknowledge shortages.
It will go back into China so long as there is the arbitrage. I mean, there are costs involved in arbitrage, obviously, but I can't see how the Chinese banks with branches in London will just sit on their hands and say, well, there's no silver in London. We won't bother. I mean, no, there is an arbitrage opportunity. And I think they'll probably take it on Globex anyway, the international version of the COMEX. So I think that's the basis of it. I think the other thing to bear in mind is that if you look at the value of base metals measured in gold, because gold ran up quite strongly, it may be a bit ahead of the game in terms of the falling purchasing power of paper currencies, but nonetheless, it means that it has left behind base metals and other commodities, which basically is what the gold's value represents. And so I can see in 2026, I can see a substantial uplift in commodity prices measured in gold.
Commodity pricing rarely moves in isolation. Currency weakness usually shows up first in metals. Alasdair Macleod highlights that gold's strong rise relative to base metals may signal fiat purchasing power erosion rather than simple commodity cycles. Historically, during inflationary periods like the 1970s, industrial metals lagged gold initially before catching up sharply. If commodity repricing accelerates in 2026 as suggested, manufacturing costs and energy inputs could rise simultaneously. That environment typically pressures equities tied to consumer demand while benefiting resource producers. As Alasdair Macleod warns, commodity repricing often begins quietly, before inflation becomes obvious in official data.
And even more of an uplift in depreciating fiat currency values. So, that's going to give us, I think, a great problem with inflation later on this year.
Yeah.
I mean, you can see that the producer price index, I think you'll find that's really going to rise. I mean, we had a 3% rise overnight, but in America, but that's just the, hardly the start of it. I think there are going to be real problems on that front. And of course, as you get the falling purchasing power of the dollar, gold, silver, platinum group metals, copper will continue to rise and rise a lot more strongly than you think is likely.
Yeah, agree, definitely. But Alasdair, to your point, rising counterparty risks in silver and gold contracts with examples of major players facing significant losses on shorts. To what extent do these risks signal systematic vulnerabilities in COMEX and London markets?
Inflation warnings often appear first in producer prices long before consumers feel them. As Alasdair Macleod notes here, a sudden 3% jump in producer prices suggests upstream cost pressure building beneath headline CPI numbers. Historically, PPI spikes have preceded broader inflation cycles, notably in 2007 before the commodity boom and again in 2021 before global inflation surged. Rising metals alongside weakening currency purchasing power can strain leveraged short positions in futures markets. That's where counterparty risk quietly enters the system investors rarely see. And as Alasdair Macleod indicates, derivatives markets tend to show stress only after inflation momentum is already underway.
Well, the risks are definitely there. But I think we should bear in mind that the authorities are actually quite good at hiding these things. If someone gets into trouble, they will be bailed out and we won't know about it. I mean, there were all sorts of stories on this shakeout about how, dealers were getting into trouble, therefore they manipulated the price down and all the rest of it. I mean, I don't think that's true. I think what we saw was something which was an opportunity by the swaps, by market makers, by bullion banks, basically to hit the expiry of the February contract at a time when China had packed up and gone home for the weekend. I mean, that's the time when they can just push the price anywhere they want. There's no speculative or very little speculative interest. I mean, this is an amazing thing.
Wall Street rarely needs conspiracy when liquidity timing does the work. As Alasdair Macleod points out, futures contract expiry combined with low participation can create price moves that look dramatic but require very little capital. COMEX open interest liquidity often drops sharply during Asian market closures, creating thin trading windows. Institutions understand well. That's not manipulation in the dramatic sense. It's structural advantage built into derivatives markets. Retail investors often mistake these liquidity events for genuine trend reversals. As he suggests, understanding market structure matters more than reacting to sudden price drops.
If you look at the commitment of traders figures, which separates out the managed money, in other words, hedge funds, and speculators in the other reported category, I mean, they weren't long. They really weren't long. And indeed, hedge funds have been selling gold down, certainly from around about the middle of December. It was only really in the last sort of week or so of, into mid-late January that they were actually increasing their position. So there were a few people to shake out, but not all that many. Without any speculators in there, you're not going to get the sort of volumes, if you like, which, where you got people saying, okay, it's fallen so far, time to buy some sort of thing. They're just not interested. I think they're all scared stiff of what's going on or not understanding it. I mean, you would think that you would get momentum chasers in there, but they're hardly there.
Sometimes what's missing from markets tells you more than what's present. As Alasdair Macleod notes, hedge funds were reducing gold exposure from mid-December through January, leaving speculative positioning unusually light. Commitment of traders data often shows managed money positioning as a momentum indicator, and historically low participation can suppress volatility temporarily. When funds step back, price discovery becomes dominated by fewer institutional players. That creates quieter markets but also more fragile ones if sentiment suddenly shifts. As he implies, low speculative participation can precede sharper moves once funds re-enter.
It's an extraordinary situation. The amount of speculative activity to shake out here has been virtually none, which really means, ironically, that the swaps, the market makers, I mean, they could just mark things down as much as they want without really being challenged. And I think that's roughly what happened.
Yeah, China is factor, always has been a factor, but reports of China buying large quantities of silver and gold during recent dips have circulated. But the verification remains challenging. How do we know how much China bought precious metals? And what role do you see really from the Eastern demand going forward?
Yeah, I suppose in the fullness of time, we might see, some... if you like, sort of trade statistics, but I don't think that's really going to give us much of an indication.
Markets become most vulnerable when participation disappears, but pricing continues. As Alasdair Macleod highlights, low speculation means fewer natural buyers during price declines, allowing market makers to dominate short-term direction. This pattern appeared in March 2020 when liquidity vanished across commodities before metals rebounded strongly. China's purchasing activity often becomes visible only months later through import statistics and reserve disclosures. Investors relying solely on real-time confirmation may miss early accumulation phases. As he reminds us, physical demand trends often reveal themselves long after price moves begin.
I mean, I don't think we need to try and examine this, to overthink it, to examine it too deeply. Just look at the premium in Shanghai compared with prices in the West. I think that's all you need to look at. And as long as the premiums are there, you can bet your bottom dollar that it's going to drag us up. And that's actually what's happening today. I mean, we've had a pretty good rally today. I mean, as we talk, I can just get my chart up. I mean, we're looking, silver is up 12%.
Yeah.
You know.
Gold is nearing 5K again, right?
Yeah. I mean, gold is interesting because there isn't very much difference between the price on the Shanghai Gold Exchange and the spot price in London. There's not a lot of difference. And I noticed also that JP Morgan are now forecasting a price at the end of this year of over $6,000, which tells me that they've got an even to long book.
When major banks turn bullish on gold, positioning often matters more than forecasts. As Alasdair Macleod suggests, JP Morgan projecting gold above $6,000 may reflect internal positioning rather than purely economic modeling. Large institutions historically adjust price targets after accumulating exposure, something seen during the 2009 to 2011 gold rally. A 12% silver rally alongside narrowing gold price gaps between Shanghai and London hints at strengthening global demand alignment. Institutional forecasts can sometimes follow markets rather than lead them. As he implies, bank price targets often reveal positioning shifts before fundamentals become obvious.
So, I think that's the way of it. I think that they're probably more frightened of getting short in silver than they are gold. I mean, there is a bit of a flow in gold, and you can keep your position level. Perhaps when gold ran above $5,000 up to $5,500, there may have been some who found that they were net short. You're looking at positions across COMEX and London. And on that basis, they would have joined in, hitting the price, banging the price as much as possible to try and get some stock back. But there again, if you look at the contraction in open interest, I mean, it wasn't as much as you would think on a hit in the price of that magnitude. So, I mean, we know what's happening to gold. The managed money category are just not interested broadly. I suspect they're all chasing, tech stocks and things like that, which is yesterday's story.
When open interest barely falls after a sharp price drop, it suggests control rather than panic selling. As Alasdair Macleod points out, institutional traders appear more cautious about shorting silver than gold, which reflects tighter physical supply risk in silver markets. COMEX open interest historically drops 10 to 15% during liquidation events, yet this contraction was smaller despite a major price swing. The disconnect hints that hedge funds remained focused on AI-driven equities instead of metals. For investors, crowded tech positioning often signals late-cycle behavior, and as he warns, neglected sectors sometimes move first when sentiment shifts.
If not digital currency, any form of gold standard again?
Well, they're not. That's not the plan. It really is not. I mean, I think China has plans to put the yuan for trade settlement purposes onto a gold standard. But, the technical way in which she will do that, we'll wait and see. But, that is a very, very different thing. If it's actually on a gold standard, then a currency, whether you call it CBDC or whether it's bank credit or whatever, for a particular purpose, that will secure its value, which is fine. I mean, that's like sort of, if you like, a new spin on Bretton Woods. And it would work in China's case, I'm sure, because they've got the underlying economy which can make it work, which wasn't the problem, wasn't the case with America. I mean, America was trying to rule the world and all the rest of it, and spending way beyond its means all the time. That's not the situation in China. China can actually keep her spending under control.
A trade settlement gold anchor is very different from a domestic gold-backed currency system. As Alasdair Macleod suggests, China experimenting with gold-linked settlement mechanisms could reshape commodity trade flows without replacing fiat money internally. Since the 1971 Bretton Woods collapse, global trade has operated on floating currencies, making even partial gold linkage historically significant. China's debt-to-GDP ratio, near 80%, remains far below many Western economies, exceeding 120%. For investors, this signals potential long-term support for commodities and resource equities. Watch how this evolves, because he believes settlement systems could redefine currency trust.
She doesn't have all the welfare commitments and all the rest of it, which is so destructive of Western economies. I think is also possible, and this is something which something I've been airing over the last few weeks. It's also possible, I think, that China might, because she's got very strict exchange control regulations, separating off international use of the yuan for trade settlement purposes from the domestic use of yuan. She could easily, at some stage, put the domestic yuan onto a silver standard.
Yeah.
And then she would have to regulate the price between gold and silver. But she could do that. I think once silver rises to the point where you're looking at a gold-silver ratio of less than 20 and probably in the order of about 15 or 12, then I think she could do it. Yeah, I mean...
Do you see that happening? The silver ratio of 15
possible.
to 1?
It's quite possible because, as I said earlier, I mean, the last metallic standard that China had was actually a silver standard. And I think it's in the psyche of the Chinese that is real money.
The gold-silver ratio has averaged near 60 to 1 for decades, making a return to 15 to 1 a radical monetary shift. As Alasdair Macleod explains, China's exchange control system allows separation between domestic currency policy and international trade settlement in ways Western economies cannot replicate. Historically, China operated on a silver standard until the early 20th century, which still influences cultural perceptions of money. If silver were monetized again, mining equities and industrial supply chains could face sudden repricing risk. Portfolio diversification becomes critical in such transitions. And as he notes, monetary history often repeats unexpectedly.
And I think also in India, it's the same situation there. The silver is accepted as real money. And I think India could also do the same thing if she was minded to do so. And again, India has got the exchange controls, so she could do that. What that means, and this is an interesting point, is that we could see something like 2.5 trillion of the world's population, which is what, 30-odd%, 35% of the world's population, on a silver standard. Now, that's something to consider.
Monetary shifts matter most when population scale meets cultural trust in metals. As Alasdair Macleod notes, India and China together represent roughly 35% of the global population, making any metallic standard discussion economically meaningful. India remains one of the world's largest silver consumers, importing thousands of tons annually for savings and jewelry demand. If even partial monetary linkage occurred, global silver supply chains would tighten quickly. Investors often underestimate how cultural saving habits influence commodity demand cycles.